logically third iteration of coffee break. Do you have your coffee today?
I do not have my coffee today. I actually completely forgot. I'll 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 have a cup when listening to the recording.
All right, that works. That works. Well, I brought at least 3 shots of espresso for both of us, so we can split a 1.5, and we'll make it work. So,
Very nice. Thanks for having me.
oh no problem. For those who are going to be looking at this, we have a little bit of a color change from our last little coffee break here. We had a blue background with the Logically, but for those who can see in my upper right here, we have a new logo that's purple, and we have a part of a new family, the Vetify and Logically family. And pretty exciting news here, Colin, I would say, right?
Absolutely. We just recently changed team and are now part of the Vetify family. It's a very exciting opportunity for us to join a company that has been very invested and very involved with making the life of financial advisors and the asset management industry by large easier since day one. As you know, Andrew, logically, we see ourselves as like the bridging gap between people that are creating products and their consumers. And we very much subscribe to that feeling when joining forces with Vetify. I think it's going to be a great adventure. We have a lot of synergies, we have a lot of opportunities, and we're looking forward to serving our clients even better as part of the Vetify family.
Oh, that's awesome. No,
And purple is a great color theme, so very excited.
No, exactly. We just, the entire team is very excited to be a part of the Vetify family, and looking forward to, definitely getting together and celebrating in person. And, before we kind of dive into our conversation here today, Colin, I want to kind of set the stage here and kind of get a little bit of background on yourself. You are our chief strategist here at Logically. And, you've had quite the experience before coming here. You are a CFA charter holder, former high-frequency fixed income trader. You hold multiple master's in science degrees from French universities, one in electrical engineering and one in quantitative finance. What kind of has been your experience that kind of led you to Logically?
Yeah, that's something that I would, not consider very interesting, but I'm happy to tell you a little bit about my background. It's been a journey. I'm an electrical engineer by trade, as you said. When I graduated, my specialty was signal processing. As you may know, signal processing relies on a lot of applied mathematics, so know-how, concepts, techniques, and I'm actually very grateful for that curriculum, which gave me a very practical knowledge of modeling random variables, and if I were to summarize it, like it actually trained me in approaching problems in a probabilistic way. I don't know if that resonates with you, but I always see the expected value when doing something. What's the probability of success and what's the reward? I think that here logically we're all about tackling projects that have positive expected value. And so that's where I started. I started working in the defense industry, worked for a while on a field of mathematics called graph theory. It was pathfinding under constraints optimization problem, and I really had a blast. It was very stimulating, very interesting. And it led me to believe that I wanted to work in operational research. And so for that reason, I quickly made the jump to the financial market industry, where actually, in a way, the outcomes of your research are very immediate and very easy to quantify. If you're good at your job, you usually know it very quickly. For the anecdote, when I made the jump, I had no training in finance whatsoever, and I was definitely very overwhelmed by the language. People were talking about shorting calls and buying futures, and I was looking at them like, what language are you speaking right now? But at the same time, I realized that the overlap in terms of techniques or technical know-how was significant. So I went back to school. You're right, back in France, born and raised there, to acquire a second master's degree in quantitative finance. And I pretty much learned learned the language. I was able to communicate, so it made my life a lot easier. And right after that second stint in grad school, I joined one of the leading European algo prop trading company, where I spent 7 years working on the algo trading architecture and the strategies. I won't go into too much detail, but it was systematic factor-based trading, where we had this, in my opinion, interesting, and I understand if people don't feel that way, model where you would automatically hedge your exposure, trying to cancel out some of your factor exposures, and it would pretty much trade itself all day, and it was very rewarding, very interesting. A lot of good days, a few very bad days. I think it's the experience shared by a lot of people on Wall Street, and for the longest time it was very exciting. What made me join logically, after a while, I was actually very interested in understanding a little bit more longer term portfolio construction, working on investment strategies that go beyond 1 hour or a few minutes of holding time. And that's when I started taking classes for the CFA curriculum and all the things you mentioned. And in that process, I actually met Dan and Emil, who at the time were starting to build what was previously ETF logic. In my mind, the calculus was with the following: in any kind of algo trading job, you spend a tremendous amount of time maintaining your data feed, like cleaning the data, making sure you got the files you expect overnight, et cetera, et cetera. And it would be it would happen a lot that we would not turn on trading before, let's say, half an hour after market open, because we needed to make sure that we were relying on trustworthy data and that our model had been trained on the right information, et cetera, et cetera. And so when I chatted with Dan and Emil, it was like, hold on, you're telling me that I'm going to have to do this data work, which I kind of always took as a sunk cost, but now someone's going to be paying me to do that. Like, that's the service we're going to be offering. And the rest of the day I can spend on very interesting problems that like are related to portfolio management, like risk computation, et cetera. That sounds awesome. So that's when I made the jump, and I joined Logically a little bit over 4 years ago. I was also, past those very practical concept of, hey, I need clean data. I've always believed that ETFs were a very efficient way to invest, very cheap. I see them as the building blocks of what is a good portfolio right now. I think we can chat a little bit more about that later, but logically we're very much on this concept of wealth management. You might want to call that 3.0 if ETFs were wealth management 2.0. And in wealth management 3.0, you still rely on ETFs for some part of your portfolios, but you're making it maybe a little bit more dynamic, maybe a little bit more tax aware, maybe, and so you leverage these incredible instruments that you have right now at a fraction of a cost. If you were to yourself replicate an S&P 5 strategy, it would be tremendously difficult. You can just now hit the market. You have multiple options. You have overlays. You have future synthetic replication method. It's incredible. So I was very excited about that, and that was absolutely part of the reason I wanted to get on board at the time when again, Logically did not exist and was called ETF Logic.
Well, that's quite the journey, and I think what you kind of led me to here kind of takes us to where we want to go next, about how you view the ETF as part of the building blocks of not only just portfolios, but just a strong asset management business, and it will only continue to grow as we've seen, especially since 2008. The ETF industry has continued to blossom with hundreds of billion in inflows going year in and year out.
Oh,
And
absolutely. Yeah. We see that every day. Like we keep on seeing new products being launched. We keep on seeing a lot of intelligence being brought up to the market. I mentioned a few things, but when I started, it was I think it was 2,700 ETFs in the US. Now the number is much higher. And we see, mass adoption because it just makes sense. It's just very easy. We also, realized very quickly that although there is a growing importance for ETF, that's not the whole picture. And I guess we can talk about it at some point. But when we look at the portfolio that we're keeping track of on the Logically platform on behalf of some of our users, there are significant positions in single stocks and mutual funds. So we quickly added that. I hope I'm not, divulging any secret when I say that's part of the reason why we dropped the ETF and ETF Logic and rebranded to Logically, because we have this holistic approach to investing, and we support beyond ETF. That being said, we feel like this is the asset management industry keeps on moving the goalpost and keeps on coming up with very innovative solution. When I started, there was no active non-transparent structure. There was no buffer ETFs, or they were just starting, et cetera, et cetera. So all these are now available, and with the competition, they're very not expensive if you want to add that to your portfolio. So we're very thrilled to serve that market and that industry, and we see a lot of potential for growth still.
Oh, I completely agreed. And I think that's a great segue to question number 2 here. And, you designed, help to design part of the main engine of what we have at Logically within the platform, and that's our portfolio analysis engine. For those listening, our portfolio analysis at Logically is an in-depth look of your portfolio under the hood from multiple different vantage points. And just to keep it at a very high level, and, I would love to understand, you kind of made it a little bit in your comments here, but the genesis of how portfolio analysis within the Logically framework came to be, and on top of that, what sparked the initial genesis of our second engine, our Logically Portfolio Coach, which has an AI component. What was the initial idea, kind of how that came to be?
That's a great question. So in order to answer that question, I would like to emphasize two thoughts. At Logically, we see our mission, our why statement, in the following way. When you're an investor, we want to help you understand 3 things that we see as very important. The first one is know what you own in your portfolio. Make sure that you have a good understanding of what are the exposures, what are the drivers of risk and return in your portfolio. A lot of times we encounter a situation where people are surprised to realize that they are owning the same exposure in multiple securities. And that was one of our first mission. When I mentioned before that we started as ETF analytics company. The first thing was really this idea of, hey, let us highlight for you what's under the hood of the fund you're buying right now, and let us understand what you're adding into your portfolio. Once you have this plethora of options in front of you, we are fairly technical people, and we understand very well that although 2 funds might claim to do the same thing, let's say they have the same index, a very simple example, they're tracking the same index, very subtle differences, maybe the replication strategy that you're using for that index. Are you buying everything? Are you sampling it? Are you using a future overlay model to actually acquire that exposure, et cetera, can produce tiny differences that on the long run accumulate to significant deviations. And that's what we were very focused on going beyond the surface of this is a very, high yield corporate bond fund. Just the way they manage the distributions, the coupons. Do they reinvest them? Do they keep it in cash? Those accumulate to very big differences, as I said at the beginning. The second point is like, and that's this idea of, you have multiple options, is once you know what you want to put into your portfolio, you have to make sure that you're paying the right price for it. And the price is, when we talk about ETF, is obviously expense ratio. That's the first thing that everybody will see, but there are sort of hidden costs, true costs of holding a fund, and that's something that we have spent a tremendous amount of time on, and that we really see at the core of our mission. And finally, this is more of a I don't know how to say that really, but like a good principle to follow. Stay invested. We do believe that ETFs, they're pretty much every flavor of ETF you can think of. And the worst thing you can do as an investor is pull your money out of the market. There are many academics paper that I have on with multiple angles and multiple methodology have highlighted the benefits of increasing your market participation. And one way to do that is very simple. Like when the market gets volatile, when you feel like you're losing the understanding as to what's driving your portfolio, etc. One thing that we strongly believe at Logically is that you should trade out of that maybe niche position and get back to maybe a broad market fund, passive fund, whatever. We've had, over the past 3 years now, I was about to say 2 years, but COVID was 2020. We've had multiple examples where, the volatility spiked. Everybody was like, I don't really know. And that's fine. That's fair. But we now have enough, back track record to know that the worst thing you could have done is pull your money out of the market in March 2020. You would have missed on a tremendous rebound. And that's really something that we see as consequential and important for the investors. So just to recap, know what you own, pay the right price, and stay invested. Coming back to your question, how those three principles translate, we started by this concept of, hey, let's accumulate data, let's build this information data lake that will allow you to sort of discover. That's the first step in efficient portfolio management, in our opinion. Shop around, by all means. Look for strategy X, strategy Y, strategy Z, compare them, make sure you have a good grasp on what's driving their performance. If it was like maybe one good bet, every single ETF that owned Tesla for a significant amount of time had looked like they were outperforming everybody. Now, if you go a little bit deeper, you're like, okay, the same strategy without Tesla, what would be the number, right? So that's what we mean. Like, and really make the effort of going into the details, understanding what's there. Once you've done that, the second step in an efficient portfolio management process, in our opinion, is to analyze. And all this very long answer to get to your question, portfolio analysis was a response to that second step. I have now an opinion. I have an idea of something I would like to add to my portfolio because for whatever reason, I think it's a suitable investment for me. I can actually ask myself questions to like, okay, how does it fit in my portfolio? Do I have already this kind of risk? Am I accumulating? Am I like, detracting on my risk? Is it a good fit for my portfolio? And finally, now that, as an investor or a financial advisor for that matter, I have forged an opinion, I can actually implement that. So that's the portfolio coach, the actual trading, the implementation of that trade and the rollout of the portfolio management strategy that you want to follow. So really 3 steps: discover, analyze, trade. And pretty much like those tools have been in response to those different steps in the portfolio management process.
No, that's an awesome response. I mean, to discover and also to analyze. I think that plays obviously really well given the fact that 6 out of the 10 best days happen within the market out of usually, to your point earlier, 2 weeks of the 10 worst days. So to your point, staying invested and discovering and analyzing, I think again that's a great segue to the third question, Colin. You're leading me right down the path here. Is with the coach, it sounds like we have some disruptive industry capabilities here. Do you think that these are potentially threatening to in some capacity because of the AI component that is within built in the coach?
Yeah, look, again, great question. I think immediately, I think it's interesting that you would start by mentioning the concept of a threat to the industry. Let's get something out of the way. First of all, without the shred of a doubt, I think that we're at the stage where AI models, supervised or unsupervised, are now capable of handling volumes of data. And by handling, I mean analyzing, extracting features, providing, views, etc., that no human will never be able to match anymore. That's for sure. So before we get into the details of how AI lives on our platform, I want to emphasize the fact that there's a good reason why we call it our trade, product, the last step in that portfolio management that I was describing before, the coach. It's because, per its name, the coach doesn't play on the field. The coach sits on the sidelines, recommends, course of actions, helps you, has this eagle eye view, but is not a trading black box. Okay, I wanna make that clear. I think, quite frankly, over the past few years, we've actually seen several initiatives to sort of systematically manage the portfolio on behalf of the investor. And when I say that, I put in a very wide spectrum, going from robo advisory up to like a few firms that have tried to solely rely on AI models to manage portfolios. And now that we have the track record, I think, or at least it's my personal belief, that they haven't found really their footing, and the industry is just not ready to blindly trust the machine. This is something that's really interesting for us because, and really important actually, we see ourselves as working alongside the advisors. We have no intention to replace them, because for the simple fact that we understand that they're the ones sitting in front of the clients at the end of the day, and they need to have the level of understanding that allows them to reassure when the market gets volatile. Everybody, without any exception, at some point is going to ask himself, like, hey, what's happening with my portfolio? Do I need to revise it? Am I invested in the right way? And will I make it for my financial goals? And we would hate for the advisors working with us to come up short and have no answer to that. So really something important. To elaborate a little bit on your answer, I think something important that is almost its tautology. Like, when you build a portfolio, the individually optimally selected securities put together will never make for the optimal portfolio. So it's really a concept that is going to come as no surprise to whoever is listening on this, but it's important that we balance out the fact that when we put a portfolio in front of the coach, it's usually an invested portfolio. It's not cash laying around. And we have to take into account that this is a dynamic process, going from, I would like to invest in this security fund sector, whatever strategy, let's say, up to the point where I have allocated the money that I wanted to put there. And we believe that this is where AI can come in, because AI, as I said at the beginning, handles now tremendous amount of data, learns very efficiently, very quickly, patterns, features, stuff like that. And you've been on Wall Street long enough. You've heard the sentence, history repeats itself, so many times. It's a godsend for AI when history repeats itself, and actually we get into a vicious circle, because the more AI is pushed, the more history will repeat itself, because AI will learn from the history. So it's pretty good. I always remember the day I heard the sentence I heard on my very first trading day, like on the market, if you're the only one to be right, you're still wrong. So you want to be part of history repeating itself, and it's really hard to be fighting alone. So, anecdote aside, I think
Tell that to
we
the perma bulls out there right now who are calling for the bull market raging on now.
Yeah, no, absolutely. Well, you're always going to have a few leading voices, and surprisingly, no one really gets back to them saying like, "Oh, you were not so much of a leader, but just an opportunistic." Okay. No, sorry, we digress. But yeah, the place of AI for us is really in to be in the advisor's corner. Okay. There are many information that we can extract both from the market, from the book of business, from the portfolios being monitored, etc. And we can really make the life of our users easier. At the end of the day, we want them to feel comfortable with how we're helping them, and we want them to understand what's being done. But without a doubt, you can actually be very, very fast, and in a very robust way, you can actually have insights on your book of business, and that's what we're all about.
No, that's awesome. And I think kind of as we get to the kind of wrap up, coming close to the time here, I got a couple more questions that I'm going to wrap together here. Because I know you are a very busy individual, have a couple more calls to make today and finish through. So again, we really appreciate you taking the time here to be able to share a little bit of insights about your background logically and where we look forward to going with the VettaFi family. And in our first conversation that we had, our CEO Emil was on, and he talked about direct indexing being one of Logically's big opportunities in the coming years. What are some of your opportunities that you see for us in the coming months, years as well, given the VettaFi relationship now and family, and also even prior to that, what were some of the things that you were looking at as where we had a big market advantage? And then finally, are there anything in the platform that you can share with us to let the viewers know of what we have coming down the pipeline about tools on the platform or unique aspects that we can share?
Yeah, so thanks again, great question. I will very much concur to what Emil was saying about direct indexing. I think we touched very lightly on that when we were talking about the general idea of the portfolio coach. Maybe something that is worth explaining is that the purpose of the coach is to establish the moment where the portfolio deviates from where it should be. Okay, you're following a strategy, you want it to be at a specific point or risk profile, exposure profile, you're not. So how do we solve that discrepancy between where you want it to be and where you're at now? Having built this architecture, having built these models for alerting, for suggesting, etc., we're very uniquely positioned to answer some of the hottest trends in the industry right now. So when you talk about direct indexing, at the end of the day, it's all about, I have this strategy that I'm trying to pursue. I want to invest in this very specific way. And I have this portfolio, which is the Andrew version of that strategy. And we're already here. Actually, we're already at the point where we can take into account your specific constraints. For instance, you and I are working in the financial service sector. It's not a great idea on paper to double down and invest our own money in financial service stocks, because if the industry were to collapse, we would not only lose money on our investment side, but we might also lose our job. So this is the kind of thing that we can input in the portfolio. Maybe in the optimization process, maybe you got inherited stock gifted to you by your grandfather, grandmother, whatever, and they're now at a significant gain. We can input that in the optimization as well. We can say, hey, that part of the portfolio, if Andrew were to trade out, this would generate a significant tax event that we have to take into account. On the flip side, if you're at a loss, and this is my second point, the tax aware thing that we are very much ready to tackle, and we're actually releasing now these days. If some of your investments are currently incurring a loss, we have all the technology, we have all the knowledge to not only flag that out for you and tell you that there's an opportunity to harvest a certain amount of losses, which will translate as a tax asset come April 15 next year. And we also have the opportunity to suggest some replacement securities for you. So again, following this concept of Andrew is invested in a strategy, he's pursuing certain goals, we have that information and we can help optimize that dynamic path to the goal, right? And when you start digging into this concept, I mentioned direct indexing, I mentioned tax aware, we can go through thematics. However you want to define thematics, you know, maybe I know you're a big golf guy. Maybe there is a big golf company out there that is buying everything. You know, this might be a personal preference of yours, and we're very much ready to take that into account as the future of investing. So, you know, to make it a little bit more concise, and because we're hitting up on time, I would leave you with this. Like, I believe that for the longest time, we were in the area of big data. It was all about gathering and having exhaustive coverage of specific areas. And, you know, even, you know, the quant finance industry, those big hedge funds have been looking for what they call alternative data. So it was pretty much finding data everywhere. And logically is at the forefront of what I would classify or qualify as the smart data. Having all the data on its own is not enough anymore. And we now want to go to the next step where we digest that data on behalf of our user, and we're trying to make it into actionable insights, elements that they can incorporate in their workflows, and that makes hopefully their work life easier and faster and more efficient.
That is
the Vetify part is actually gonna just put those concepts on steroids. Like we are now part of a company that has extremely deep relationship with the asset management industry, and we see ourselves, as I said at the very beginning, as really this bridge between those products that are being launched and how they're being consumed, and we want to help that feedback loop. You know, for the longest time, it's been like the asset management industry, like forcing down, oh, this is my new ETF, this is blah, blah, blah. We believe we can help surface some information from the investor, from the financial advisor, back to the product issuers. And we can actually work for the greater good, saying like, you know, very practical things. Like right now, people would want a multi-asset strategy that is rather on the conservative side because uncertainty is high, geopolitical questions are popping up everywhere. We don't really know where to go. So why don't you guys take a look at, you know, having one of your PM run strategy like that?
No, that's a fantastic answer. And you know, just to kind of close it out here, we again really appreciate the way you walked us through not only your career before Logically, the exciting things that you built at Logically, and what we have also to come, and what we're going to be solving for with the Vetify family and us being a part of that community. And again, Colin, really
I'll leave you with the French quote, l'avenir est radieux. The future is bright. And we're going to do great things. Yes.
Well, we look forward to having you again on Coffee Break, my friend, and we hope to have you back soon. Thank you again.
Thank you so much, Andrew. Talk to you soon.